Hi, welcome back to Father and Son Investing. There are two important decisions that an investor will make in their life. One is, how will they distribute their assets? By that I mean, what's the plan that you're going to use to invest? And the second decision that an investor will make is when they get ready to withdraw their money, at what rate will they be doing that? 4% has been kind of a very common method for doing that, but there are some people like Dave Ramsey who advise 8% withdrawal rate. Today we're going to talk about the first question: what plan will you use to invest your money? And we're going to use advice from the most famous investor on the planet, Warren Buffett. Back in the 2013 Berkshire Hathaway investment letter, Warren Buffett offered what he called some thoughts about investing. I want to highlight one particular paragraph in those thoughts for you. Now, as a prelude to this paragraph, Mr. Buffett noted that most of us are not professional investors, and thus we might not have the knowledge base that we would need to investigate particular companies. But he said, don't worry about that. The average investor doesn't need that extensive knowledge if they just use the S&P 500 to diversify themselves. So here is the paragraph that I want to highlight. It says, what I advise here is essentially identical to certain instructions I've laid out on my will. One bequest provides that cash will be delivered to a trustee for my wife's benefit. He goes on to say that he won't have any Berkshire shares to give to his wife because all of those Berkshire shares that he has are going to be given to philanthropic causes. In fact, he noted that he'd already distributed quite a bit of his shares to philanthropy. But he goes on to say, my advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. He suggested Vanguard. In today's video, we're going to address two questions. How viable is the 90-10 way of investing? That is 90% in the S&P 500, 10% in short-term government bonds. Some people like to call this the Warren Buffett two-fund way of investing, or the two-bucket way of investing. And we're going to address the question, if you followed this method, what is the likelihood of running out of money before you run out of years? Let's get into this. In 2015, this paper was published from the IESE Business School in Barcelona, Spain. The author is Javier Estrada. Now, Mr. Estrada wanted to test this 90-10 way of investing. And so what he did is he went all the way back to 1926 and took rolling 30-year periods, essentially coming up with 86 30-year periods between 1926 and when he published this paper. And then he went and looked at the 90-10 way of investing, 90% in the S&P 500, 10% in short-term government bonds, versus other ways such as 100% and 0%, or the very well-known 60-40 split, and even multiple others. Then he went ahead and calculated multiple different parameters from the data that he had collected. We're going to start talking about that now. I think the most important one to talk about and to answer the question first is, what is the likelihood of running out of money before you run out of years if you use the 90-10 way of investing? So what is the likelihood that the 90-10 way of investing, you would run out of money before you ran out of years? We're going to call that the failure rate. And what you can see here, 90-10 is here in orange, and it's 2.3%. So there is a 2.3% chance that once you retire, if you were invested this way, that you might run out of money before you ran out of years. Now let's just go ahead and look at some of these other ways of investing and what the likelihood is of running out of money. The big thing I want to highlight here for you is the 60-40 method using Mr. Estrada's methodology. 0% chance that you run out of money before you run out of years. 0% failure rate. Going at the 100% stocks and 0% bonds, it's a 3.5% chance. And if you're not very aggressive in your investing, if you only do 30% stocks and 70% bonds, 12.8% chance that you're going to run out of money before you ran out of years, at least based on the past. One of the other things that he calculated would be how much money would a person have after 30 years based on their style of investing. Now, it's important to give you some details here. He took $1,000 invested and then had a 4% withdrawal rate in retirement. So we need to keep that in mind. It's $1,000 was the initial sum, 4% withdrawal rate. So if you invest In the 90-10 way, $2,638 is what you would have. So obviously you'd have more money than you started with if you were invested this aggressively based on the past, but also remembering that 2.3% failure rate. If you invest the 60-40 way, the way that we learn traditionally how we should be invested by the time you're in retirement, you would have $1,267. So this is an average, remember, and so most people would still have more money than what they started with. If you invested in that not very aggressive way, the 30-70, you'd have $423 left on average. Now, everybody is not average. Obviously, there will be some at the top percentile. So Mr. Estrada also went on to calculate how one would do at the top 1%, top 5%, and top 10%. Well, you can see if you're invested really aggressively and you're in the 100-0 method, at the top 1%, you would have $12,000 when you ran out of years. If you're invested in the 90-10 method, about 2/3 of that, $8,625. And if you're looking at the 60-40, you're looking at about $3,208. Now, this is if you're in the top 1% of all of those 86 different rolling 30-year periods that he calculated. Now, if you want, you can stop the tape here and just look briefly to see how you do in the top 5% or the top 10%. But moving on to the worst years, now, if you are in the worst, the bottom 1%, what's your likelihood of running out of money? You'll see everything here is 0 except for the 60-40 method. That person still has $2 left. If you're in the bottom 5%, you're doing much, much better here. The only ones who run out of money are the ones who aren't invested aggressively enough in that 30-70 profile. And if you're in the bottom 10%, well, you can see that you're still doing quite well, except if you are not invested aggressively in that 30-70, you're going to run out of money. All these others ended up with still money left to bequeath, perhaps to their heirs or to charitable giving, but not nearly what the average was. So today we've answered 2 questions. Number 1 is the 90-10, 90% stocks, 10% short-term government bonds, a viable way of investing, especially in retirement. And the answer to that, I think, is resoundingly yes. However, we can also see that compared to the traditional 60-40 method of being invested in retirement, that the 90-10 method provides significantly more money, potentially significantly more quality of life, significantly more money to spend on loved ones than the 60-40 method. Number 2, the second question that we've answered here is, what is your likelihood of running out of money if you were invested the Warren Buffett way in retirement? 2.3% chance. I want you to remember that. Keep that in mind. Now, in tomorrow's video, I'll be discussing which of all these S&P 500 ETFs might be the best for you and how much difference really does it make. If any of this information was helpful for you, please give us a thumbs up and share it with someone else in your life. And as always, until next time, enjoy your investing.